Chapter 9, S2 Trade Entry Signals. This is the chapter that you've been waiting for. This is the chapter where we're going to go into the exact entry parameters for the S2 trade. We're going to go over short and long examples. We're going to go over the key levels that you need to use every single day to identify if this is exactly when you should be entering. And I'm going to give you the S2 Trader Checklist. This is a checklist that I need you to use every single morning before you trade. By using this checklist correctly, you're going to keep yourself out of poor trades. It's going to keep you out from getting in early. Instead of having all 10 out of 10 parameters met, or however many there are, the checklist will let you know, hey, we only have 9 met. Wait for that 10th one or don't get in yet. So let's begin with key levels. The first 2 levels I want to discuss are initial high and initial low set during the Asian session. These 2 prices are reached between 5 p.m. and 1 a.m. That's when the Asian session is trading. We look at the chart and we look at the wicks to determine the high and the low set during that range. We can then subtract the high from the low to get the Asian session range. This range is very important for us when trying to qualify a trade. One of the first things on the trader checklist is going to be, is the Asian range tradable? If you reference back to the earlier chapters when we talked about base pairs versus cross pairs, we're going to tie that together now with explaining to you that base pairs, you never want to trade if they have a Asian range value greater than 50. For any cross pairs, you don't want to trade them if their Asian range value is greater than 75. The reason for these ranges is because if the market decides to do something irregular, let's say, for example, on Euro USD, which is a base pair, let's say during Asia some type of news event happens that was unexpected and it causes the Asian range from initial high to initial low to, let's say, be 120 pips, which would be crazy. You would just avoid that pair the rest of the day. Just take it right off your watch list. There's no reason to trade it. Now, inversely, if that Euro USD pair had only moved 30 pips during Asia, then we're good to go and we're ready to keep moving down the checklist to see if we can qualify this for a trade at some point during the day. Let's go over an example. To measure initial high and initial low, there is a tool on TradingView that you can use, but any charting software will allow you to do this. What you do is you calculate from the start of the day, which we know is the period separator. You calculate from here 8 hours ahead, which is 32 15-minute bars. You can see it calculates it for me right here, 8 hours, 32 bars. And when you measure this, remember, the only thing we're going to measure with wicks is the Asian range. So you start from the wick high to the lowest wick possible, which is right here, right before the Asian session closes. And that would show us that during the Asian session, NZD USD, which is a base pair, went 45.3 pips. Would that be a valid tradable Asian range? Absolutely. Let's take this a step further and label our initial high and initial low. Here you can see we draw these levels, initial high, right here, from the candle bodies, not the wicks. You see the space between the wick, there's the blue background of my box, and then the pink line. That's intentional. And again, down here, you can see the initial low of day is drawn to this body right here. Not to this wick or this wick, it's drawn to this body. And I'm going to give you a few examples so you can see. You want to draw initial high and initial low on candle bodies, but you want to measure the Asian range with the wicks. So again, one more time. You want to measure the Asian range from wick high to wick low of the first 8 hours. You want to label initial high and initial low with the bodies from that Asian range. Again, here we have initial high marked in the Asian range with a pink horizontal line. You have it marked on the highest candle body close right there. And again, initial low is actually the start of day candle right here. That is the lowest body that we have. We then measure it with that box to the wicks. That's why there's that space. Another example here, and actually a good example, I like this one a lot because here you can see initial high is set right at the start of day, and we drew that pink line straight across. Initial low is set down here. However, there were pins that went a little lower, and then there was this huge pin here that actually set the Asia high. So you want to always remember to measure the Asian range from wick high to wick low, and you want to mark initial high and initial low from the bodies, not the wicks. One more example here. I want you to see that we again marked initial low at the bottom of that doji candle with the wick being a little bit lower than that. That's why the box extends a little bit lower. Here we marked initial high right here, which the same candle did create the Asia high, the top of the box, but it is not what we would qualify as the initial high of day because it's not a body. We measure initial high of day from bodies. You measure the range, how far did the price move, with the wicks. Let's dive a little bit deeper into the Asian range. Trading within the initial high and low set during Asia is always going to be risky. Trading a blown out Asian range, like I just told you, is also going to be a big no-no. You want to avoid these cross pairs that go 200 pips, in there. You want to avoid these cross pairs that go 200 pips in the Asian session. It doesn't matter how far they went in Asia. If anything, that means that they're going to consolidate the rest of the day because they've already got the move that they need for the day, and there's no reason for them to continue in that direction. They've already made their money. So let me show you why you want to be very careful trading inside that Asian range. We call it inside the box. This will show you, this pair right in front of you, that before we get into the second half of London, which happens over here, the first half of London has a very hard time breaking that initial high. Until that level is broken, we don't know that the market can actually bust through and continue to move long. So we want to wait until this level is broken, which it gets broken right here. Now, you'll say, Austin, look at these wicks through the pink line. Isn't that breaking it? No. When we talk about breaking levels, we're only going to discuss it with a candle body. Remember, the only thing that wicks are good for is measuring Asia high to Asia low. The rest of the time, we need to see candle bodies close. So for this example, when we want to go long, when we're looking to potentially take this pair long, and we don't see it break out of the box yet, we will wait, be super patient until it does break out of the box. Now that it does right here, that knocks another check mark off of our checklist that we're going to go over at the end of this chapter. Once it breaks out of the box, even with one candle, it's off. That is perfectly fine to qualify to say to me, yes, Austin, this broke out of the box today. But you need to measure those levels very clearly to make sure that you see if it breaks out or not. Now, some days you'll see moves extended to the long side after you get the breakout to the long side. We're going to go over those trades in a little bit, but I just wanted you to understand with this slide the importance of not getting involved in a trade until it breaks out of the Asian range. You want it to break out of the range before you get involved in a trade. Let's look at an ideal Asian range setup. So the first thing let's talk about is that we're looking at a cross pair. GBP, JPY. There's no US dollar in there, so we're looking at a cross pair. The first thing we're going to do is ask ourselves, is the Asian range valid? Well, we're looking at a cross pair, which means that it cannot be more than 75 pips. You can see that I measured here with my blue box to show you that the 8 bars, the first 8 hours, the first 8 hours was 32.4 pips. So that's perfectly fine. We could check off that, yes, the Asian range is valid for today. Now, did we break the initial high or initial low with a body before we would be looking to take this for an entry? Absolutely. Right here, we can see that 2 candles close above the initial high set in Asia. Great, we broke out of the box. Now, candles use the initial high and initial low levels as solid support to make moves off of for us to find S2 entries. What do you find later in the day here? Now, I repeated the word wait last slide like 18 times for a reason. Just because you know that the liquid 50 is in the buy zone here and you'd be looking to take this long does not mean that you could just hop in right here because you'll sit through all this pain or possibly get stopped out. And that's not what we're here to do. You want to catch the breakouts as pain-free as possible. So by seeing that it breaks out to the long side, coming back into the Asian range, retesting and holding that 50 EMA, moving back out to the long side with a solid, really solid bar, a nice igniting candle here, look how it retests and holds the level again later in the day with 3 pins and a move off of it holding the 13 EMA. So by labeling these initial high and initial low levels, you're able to use them all day long and spot moves off of them and say, hey, Austin, we're getting an S2 entry off yesterday's high and initial high. This is a great entry signal, right? I hope that this is starting to make sense for you as you see how important these key levels are. Here's another example. We're looking at USD CHF. So here we're looking at a base pair. That means that it can't be more than 50 pips. And as you can see, 20.2 pips for the first 8 hours. That means we're good to go on this Asian range. Do we break the initial high or initial low with a body before we would be looking to trade? Absolutely. Breaks out to the upside right here, comes back in, holds that 50 EMA, and then moves out again, giving us what looks like right here, a 3-candle Rocky formation up with Rocky's arms pointing up, second leg, right leg, closing higher than the first leg, and then the extended move up. So you can see liquid 50 in the buy zone, you get the 3-candle formation off the key level of initial high of day. You start to see how I'm tying this all together? I hope it makes sense. We're using the EMAs and the liquid 50 to determine the direction of the trend. We're now using the Asian range to qualify the pairs even more to say, yes, this has some volume, this has some juice. We are not blown out, meaning we haven't gone too far in Asia. We've gone just enough, and we've broken out of the initial high and initial low like we did right here to signal to us as traders that we are in line for potential of more of that move. We're in the right position to catch more of that move. There's a few more key levels that I want to hit really quickly before we move into more entry signals. Yesterday's high and yesterday's low are also just as important as initial high and initial low. When they become important is when you are trading near them. I'm going to say that again. When any of these levels, initial high, initial low, yesterday's high, or yesterday's low, any of those 4 levels, when you are trading near them, that's when they become very important. Meaning, if you're looking to go long through yesterday's high and price is right at yesterday's high, you might want to see it close through yesterday's high to confirm that that move is going to extend more to the upside. The other important level that I want to talk about really briefly is just the period separators. I had mentioned them earlier in the course, just that they separate the day-to-day trading on the charting software that I use. So here, we're going to go through just a few examples of how to draw yesterday's high and yesterday's low. We have to locate first the period separator, which is the black dotted line right here. If we're trying to trade in this day, look back to the day before and see where is the lowest candle body. Right here. You mark it with a pink horizontal line and you move forward. You can see that the next day we get clean moves off of yesterday's low. First move, pull back, holds yesterday's low, and then another move off of it. Liquid 50 in the sell zone all day, RSI in the sell zone all day. You'd be looking for sells all day here off of yesterday's low. The initial low here is set a little bit lower. So yes, it's also coming off initial low. That's typically what's going to happen when you're in a clean downtrend like this one. Another example here, yesterday's low marked at this body here, held here. We can see consolidates through Asia, tries to move higher, can't break the 200 EMA, breaks under yesterday's low, retests yesterday's low, moves right off of it again. What do we have on the TDI? Liquid 50 telling us we would be looking for sells. All we need to then identify is when is the RSI crossing in the right zone with the right EMAs off of which levels. Here we have the RSI crossing in the sell zone multiple times off of the key level of yesterday's low. It's kind of basic. I want you to really understand that it's 4 main levels. Yesterday's high, yesterday's low, initial high, and initial low. That's it. Again, yesterday's high, clear, marked with those 2 bodies, never the wicks. You can see it finds some resistance there as well the next day because we're in a long-term downtrend. You see how we're under that long-term dark blue, blueberry EMA. That tells us that even though we might move up in the short term, the overall direction of this market does want to go down. So we find here yesterday's high. The next day, it holds it as well. It moves down off of it twice. So you can use these levels as very, 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 very strong support and resistance levels. And it's not rocket science. It's not some secret thing. It's because everyone sees these levels. Every trader is able to identify yesterday's high and yesterday's low. Another example of yesterday's high, you just mark it from that top doji, draw it straight across. You can see you get a solid body through that price level, which tells us that we should see continued movement up. It comes down, retests it with a small little pin, holds the 13 EMA really nicely as the liquid 50 starts to move higher, and you get the move up. So again, using it as resistance or support and confirming it with the TDI allows us to trade off of yesterday's high, yesterday's low, initial high, and initial low. I mentioned this a couple times already, but again, just to show you the period separators, here's what they look like. The black dotted lines, they are what separate the day-to-day trading for us. Let's discuss daily pivot points. Pivot points are used by many traders. I've seen a lot of people use them over my trading career in different ways, honestly. There's weekly pivots, there's, I'm sure, hourly pivots, but what we focus on is the daily pivots, standard daily pivot points, which are probably, I don't have statistics for it, but probably the most widely used of all the pivot points. And that's honestly what leads us to being so confident in them for take profit levels and to keep us out of potential trades. So as you can see here, I wrote, we can use pivots to keep us out of false breakouts. I'm going to show you this in a few examples, but in words, I can explain it as if you're near a pivot point and you're looking to trade, you want to consider that pivot point like a wall in front of your potential trade. You want to ask yourself, is there enough room for me to get the kind of pips out of this trade that I want before we get to the pivot point? Because if we get to that pivot point, I might find support or resistance, and I might see some consolidation or even a move away from it. So if there's not enough room in between you and that pivot point for that trade, use the pivot in that situation to keep you out of the bad trade. Here you can see I've now added pivot points to give you the final piece of everything that I have on my charts. The chart you see in front of you is exactly what I have on TradingView, available for you for free. I have it on my charts. This is how I do all of my markups. Here it is. You can see the EMAs, you can see the TDI, and now we've added the purple lines for the pivot points and the daily pivot, the most important one where we'll see the market return to over a longer period of time. I marked that in white. You can see that down here. It's marked with the P. Each day, these pivot points are going to repaint themselves at different price points based on the previous day's price action. And you can see in this example, the market opened above the daily pivot, which would tell us that more likely than not, the move for the day is going to be long. That's confirmed with the liquid 50 in the buy zone, RSI in the buy zone, confirmed with the EMAs trending upwards, all pointing upwards, candles above the EMAs. And all we see here is it moves above through R1, the resistance 1, comes back, retests it, moves to R2, comes back, retests R1 a couple times before then moving through R2 to R3 almost, and then coming back to R2. Notice the next day, you see the period separator, and then notice the next day, it moves to what is now called R1. This next day's R1 is the current day's R3 in an uptrend. You see how it changes just by doing the math. It does it for you, but the market will still move to those price points because of how accurately they're calculated. Here you'll see I kind of blurred them out a little bit because this is how they're going to really look when we get into the markups. You don't need them that bright purple. It's almost too hard to see. But again, the market moves from from the daily pivot to support 1, to support 2. And each time it gets to those support levels, if you really look in there, you'll see this candle here put a body through the line. That tells us it should continue to drop in that direction. This candle here put a body through the line. That tells us we should move to S3. We get to S3, put a body through S3. Where do we go? To S4. We get to S4, we put a pin there, we don't put a body through it, and it stops. Use the bodies through EMAs and through pivot points and through key levels to signal to you this is a confirmed move. If it throws a wick through something, that might be an order grab, and you want to be careful of that. So use the bodies to confirm if you are breaking key levels. The time of day that I'm looking to trade, that we trade in our VTF, that all of the traders that trade the S2 find the most success is between 5 a.m. and 11 a.m. Eastern Standard Time. We've back-tested the S2. We've proven that during this time, if you avoid the fundamental news, there is potential profits to be made, and this is the most profitable time to trade of the trading day. Now you can see in front of you how we really view our charts in the VTF every single morning. I'm using 3 time frames. Up until this point, all of the analysis that you have been looking at has been on the 15-minute time frame, which I have on the left side of my screen. You can see I have the candles and the TDI for the 15-minute time frame set up on the left. On the top right corner, I have the 5-minute chart. Same thing, candles and TDI. And in the bottom right-hand corner, I have the 1-minute chart. You can see it labeled right here, CAD JPY 1-minute chart. Candles and TDI, same thing. The reason we do this, and now we're going to get into how to use all 3 time frames, but the reason that we do this is because the 15-minute, I want you to think of it almost as your window. You can't trade, or in this case, jump through a window if the window is closed. So you're going to use the 15-minute to open that window for you to jump through. But you're still not going to jump through the window until you get the 5-minute or the 1-minute S2 entry. When you get the cross on the shorter term time frames and the 15-minute window is open, meaning the RSI is above the liquid 50, above the trend line in the right position, those short-term crosses on the 5-minute or the 1-minute, either one or both, are the exact points of entry that you need to identify to catch the pain-free breakouts. Let me explain that again. The 15-minute is your entry window. The 5-minute and the 1-minute are your sniper bullets. You got to open the window before you can shoot or jump through. Whatever analogy you want to use, I don't care. Understand that the 15-minute is your window. The 5-minute and the 1-minute are the precise entries that you need to identify. So even if the 15-minute is open, you might not get a 5-minute or a 1-minute cross. And that would mean let it go. There's no S2, just let it go. If it goes in the direction you thought it was, great. You're a genius. I'm so happy for you. But that's not an S2, so you don't want to risk real money in that trade. The S2 entry long is when the RSI crosses through the liquid 50 in the buy zone above the trend line. And inversely, when the S2 entry short presents, you'll see the RSI crossing through the liquid 50 in the sell zone below or coming through the trend line as well. Like I said last slide, the 15-minute is used to identify and validate the trend as an open window for you to jump through, shoot through, well, I don't care. The 5-minute and the 1-minute are used to find the precise entry to get you in pain-free and get you into profit as soon as possible. So now I'm going to give you the S2 Trader checklist, slide by slide. I want you to have everything written down so that way as we start to go through the trade examples, you can look at this checklist in front of you and say, oh, Austin met all of these parameters in this trade, and that's why he took it. Oh, this trade did not meet these parameters. Now I know I need to avoid these trades because these are bad trades. This checklist is going to keep me out of bad trades because the parameters are right in front of my face. So let's get into the checklist. The number one question that you're going to ask yourself every morning is the liquid 50 on the 15-minute time frame trending? Meaning, is the liquid 50 in one zone, the buy zone or the sell zone all day? If it has, how long has that liquid 50 been in the correct zone? Has it been in the buy zone since the start of the day? Great, that's fantastic. Is the entire trend line then in the buy zone with it? Is the RSI trending with it? Or was the RSI going crazy last night? Did the RSI hit overbought? No? So you're telling me the liquid 50's been in the buy zone all day, the RSI's in the buy zone all day, and we haven't hit overbought? Okay, this might be a potential for a long entry. We're also going to ask ourselves, is the Asian range in play? We measured, we set initial high, set initial low. Did we blow out our box? Or are we within a tradable range? Is the pair still within that initial high and initial low? Did it break out of the box yet? Is there identifiable confluence in the structure on the 15-minute time frame? Or is there divergence in the structure on the 15-minute time frame? You want to always draw your structure on the 15-minute time frame first and let it translate to the lower time frames. The lower time frames are really only used to identify the crosses on the TDI. The structure, the candles breaking out, don't judge the 5-minute and the 1-minute for that. You're going to be induced by short-term movements. Read the 15-minute because it won't lie to you. You also want to discuss with the next question you're going to ask yourself is, are the EMAs trending? Are they all pointing in one direction? Are you trading off a solid EMA? Are you not entering off the 8 EMA, making sure you're entering off the 13, the 50, or the 200 EMA? Are you making a new high of day or a new low of day with this potential trade? Did the 1-minute hit overbought or oversold recently? Because if it did, you're going to want to be careful. I've seen sometimes where the 1-minute will hit overbought, present a buy entry, and not work, or maybe not work for the full 15 pips. I've seen it where it'll hit overbought and then continue to go higher and never stop. So you just want to be consistent with your rules. One of the rules that I have is if the 1-minute has hit overbought or oversold and I'm trying to trade that direction, I avoid the trade. I want you to keep in mind while you're trading, is the S2 entry within a 15-minute candle formation? Make sure you're not getting caught up scalping 1-minute trades or 5-minute charts or none of that stuff. Make sure that the entry that you're taking on the shorter time frame is actually within a valid 15-minute candle formation. Whether it's a railroad, a Rocky, or a shift candle, make sure you're entering within one of those formations. You want to also be aware, I mentioned this already, of how close the next pivot point is. Don't take a trade that might go only 4 pips before finding resistance at the pivot point. Between the 4 pips of movement that is potentially there and your spread, there is no money in that trade. You're better off just going to the gym and enjoying your day and coming back tomorrow. I want you to also keep in mind, what's my risk reward on this trade? Think to yourself, if I enter here and I risk 6 pips, am I able to go get at least 15? Because if not, is this really worth it? Do I want to risk 1-to-1? Not that 1-to-1 is bad, meaning you put 6 pips at risk to go make 6 pips. That's fine, but do you want to do that all the time? I don't think so. So be aware, keep in mind, like I said, of your risk reward. Also keep in mind, how far is my stop loss and how far is my take profit? We're going to go into that in a few slides of the specific take profit and stop loss levels that I want you to use. But I really do need you to understand that it's important to be flexible with that. Some cross pairs are going to warrant very large stop losses. They're going to get volatile and you're going to need to be ready for that. They jump and they'll go down 17 pips and then take you up 40. So be ready for that. Not every pair is like that. And when we talk about stop losses and take profits, I'm going to show you how you can adjust in your live trading. Also keep in mind, where is the most recent shift candle? If you're going short, make sure the most recent shift candle is down if you're not entering on a downshift. Because if you're entering short in an upshift, meaning the most recent shift candle is up, you're not going to make money. So you either need to be shorting into a new downshift candle or already in a downshift, and vice versa for when you're going long. How far are we from the high or low of day? Because again, those are very key levels. And how many times did we already touch the high or low of day? If you're going long and you've already seen 3, 4, 5 hits to the high of day and it can't break it, you probably should wait for it to break through before you consider jumping on that train. Because the 4, 5, even 3 hits to the high can sometimes signal to us, hey, that's a serious level of resistance, back off. Wait for it to break before you try to trade this because this might tank. Now you're probably thinking, Austin, how do I use all 3 time frames? It's too much for me. I can't analyze all that. No. I promise it's not. Because each time frame has a specific use, but overall you're looking for the same thing on all 3 time frames. The S2 is the S2. No matter what time frame you're looking at, you can find the RSI crossing through the liquid 50 in the proper zone with the trend line in the proper positioning on any time frame. The first thing you're going to do though, when you're building a watch list every single morning, is you're going to identify the pairs that on the 15-minute have hit overbought or hit oversold, and you're going to remove them from the list. There's no reason to look at them for the rest of that day, because I told you right now, you cannot go long a pair that's already hit overbought, and you cannot go short a pair that's already hit oversold. Then you're going to look at the 15-minute TDI. And again, some of those questions that we worked through on the checklist. Is this in the buy zone? Is this in the sell zone? How long has it been in the buy zone? How long has it been in the sell zone? And if it's in the buy zone, we're going to be looking for long opportunities. I never want to see anyone tell me or post a markup or do anything about going short in the buy zone. I will freak out. And trust me, you don't want to see me freak out. You're then going to use the 15-minute to determine if the TDI and EMAs agree on trend. So we've taken off the overbought or oversold pairs. We're not even looking at those. Now we identified which TDIs on the 15-minute have the nicest liquid 50s, meaning they're trending the nicest. They're not overbought, they're not oversold, they're not near the stationary 50, they're right in the proper value. Then we're going to say, okay, if the TDI is at, let's say, 40, meaning we're going to look to sell it, do the EMAs also tell us that we're going to sell it? Are the EMAs also pointing down? You want to determine if the TDI and EMAs agree on trend. And if they don't, personally, I take it off my list too. There's no reason for me to try to trade counter trend trades. I'm looking at potentially 25 to 30 currency pairs a day. There's no reason to try to finagle it and trade 4 of them, or even 3 of them. You will find almost every day that the S2 presents at least once on one currency pair. You'll find one a day. And if I'm telling you can find at least one a day, that's plenty for you to make a career out of this. It's plenty for you to quit your job off of this. It's plenty for you to then build off of and become a better trader from. Let's go over the 15-minute entry signal in detail. So again, I blew up a 15-minute chart for you here. The first thing we're going to look at is, did this hit overbought? No, RSI never hit overbought. The second thing we're going to look at is the liquid 50 in the trending zone all day, and how long has it been there? Yes, this is in the buy zone all day, telling us this is going to go long. Now, do the EMAs agree with it? Well, the short-term EMAs here at the start of the day, you can see the 50 and the 200 are moving up towards the 800. However, it takes until London for the candles to get above the 800. Now, once the candles are above the 800, what did I tell you earlier in the course? If the candles are above the EMAs, we are in an uptrend. Then what you're looking for is the RSI to cross through the liquid 50, throw a 15-minute formation, and a shorter-term S2 entry, shorter-term time frame S2 entry to qualify this as a trade. So here you can see the RSI crossing the liquid 50 and the trend line in the buy zone moving towards overbought. On the candles, we can see a 2-candle railroad formation off the 13 EMA, and then you get a 27 pip move to the upside. Let's break down the 5-minute chart. It is exactly the same thing that I just showed you on the 15-minute chart, just on a smaller time frame. You're going to look for the RSI crossing the liquid 50 in the correct zone with the trend line in the correct position. Crosses in the buy zone mean potential long entries. Crosses in the sell zone, potential short entries. You will find 5-minute entries present the most during railroads and Rocky formations. During most railroads and Rockies, you will not find a 1-minute cross. You will instead find a 5-minute cross. The shift candle entries, you will find 5-minute and 1-minute crosses majority of the time. If it's a solid shift, you'll get a cross on both time frames relatively, close together in time, if not at the same time. Again, we're going to look at a 5-minute entry example. This looks just like the 15-minute, except here we're looking at that 5-minute entry. This is the same trade that I just showed you on the 15-minute chart, but now you can see when the RSI comes through the liquid 50 and then gets above the trend line in the buy zone, we then have our extended move up for the 20 or so pips on this pair CAD JPY. So again, when you're looking to go long, you want the RSI to be coming through the liquid 50, through the trend line, and have everything in the buy zone. Now let's discuss the 1-minute chart. Again, it's like I'm beating a dead horse, but it's the same thing. It's when the RSI crosses the liquid 50 in the correct zone with the trend line in the correct position. Crosses in the buy zone, we're going long. Crosses in the sell zone, we're going short. If you get a 5-minute and a 1-minute cross, like I just mentioned, on something, for example, like a shift candle or maybe a big Rocky formation, you should have increased confidence in that trade. If the 15-minute window is actually open and you're identifying it correctly, you should have increased confidence in any trade that you can get the 3-for-3 crosses, meaning the 15-minute, the 5-minute, and the 1-minute. If you get 2 of 3, you're still probably going to win. And I say probably meaning you'll win majority of the time. But if you get 3-for-3, very rarely have I seen that fail. In this 1-minute entry example, again, on the same pair, CAD JPY, again, you can see that before the entry on the 5-minute, you have multiple crosses in. Now on the 1-minute, we can see the exact example of the potential entry signals. We're in the buy zone, and we have 1, 2, right in there's another one, and 3 RSI crossing through the liquid 50 and above the trend line in the buy zone, S2 entry signals. So at this point, guys, you should understand the S2 is very, very, very simple. The RSI cannot have hit overbought or oversold depending on which way you're trying to trade it. You need it to cross through the liquid 50 and be above or below the trend line, again, depending on which way you're trying to trade it. And it needs to be in the proper zone. Buy zone for going long, sell zone for going short. The entire S2 pattern, you now understand. It's based on this TDI cross and confirmed with EMAs, candle formations, and key levels. I'll say it one more time just so you understand. The S2 entry signal is confirmed with crosses on the RSI, candle formations, trending EMAs, and market structure formations. So when you use the TDI in combination with those 3 things, candles, market structure, and EMAs, you will find profitable S2 pattern trades. So let's discuss stop loss rules when trading the S2 pattern. The first thing I want to state, to clear the air, again, we're going to have base pairs and cross pairs. For base pairs, you can use 8 pips plus your spread, which will normally come out to about 9 or 10 pips depending on your broker. That normally will be plenty. Even if you have a slightly late entry, if you have a solid S2 entry from the historical markups that we've done, we've proved, and if you're in our VTF, in our group, I can give you access to study all of these chart markups, thousands of them. We've proved that solid S2 entries should not pull back more than 8 or 10 pips, sometimes less than that. Now, where the stop loss does become a little bit more important is with the cross pairs, because you do want to give it a little bit more space because they have been known, and I have the pictures to prove it, the markups to prove it, they have been known to turn around, leave wicks, and then continue in the direction you thought they were going, but if you have too tight of a stop loss, they will stop you out. One of the stop losses that I've been using a lot lately is a break of the 8 EMA, because my trading over the last 3 years has become very picky, and because of that, I'm finding myself losing less and less trades. So when I do see a breakdown of the 8 EMA, meaning if we're in an uptrend and price is moving higher and higher and higher, and then we get a pullback and it closes underneath that 8 EMA, my mustard, I'll either close all of the position, move my stop loss into profit, or close some of the position, because I know from market experience that if it breaks the 8 EMA, it might continue to reverse and go break the 13 and might go all the way back to the 50, in which case I would lose money. So by pulling out at the break of the 8 EMA, one, I'm not taking the full loss of the 8 pips plus spread for the stop loss. However, I am putting myself in a position to pulling out of a trade that might continue in the direction I wanted. So again, it comes with market experience, but keep in mind that if you break the 8 EMA, you might want to start to close some, maybe half of your position. I go over this every day in the VTF. People will ask me, how did you close here? Did you close here? And I can show you exactly where I close, and if I close, how much. If the 13 EMA is broken with a candle body, broken always means with a body, never with a wick. So if the 13 EMA is broken, the trade may be wrong, and if you haven't been stopped out yet, you can't go wrong just taking the loss there. Maybe instead of losing 10 pips, you lose 4 pips. Well, listen, that's really important. The 4 pips is easy to make back the next day or even later that day if you wait for the proper S2 trade. Just don't get in early. Getting in early is going to kill new traders. So avoid that by waiting for the entry crosses that we went over in this chapter so far. You need to see that RSI coming through. Once it's through the liquid 50, then you can confidently say, yes, here's an entry, and now I know where I'm going to put my stop loss. Here's an example of a trade. You can see a railroad formation on the 15-minute chart, RSI above the trend line in the buy zone, coming through the liquid 50, not having hit overbought yet. From this trade, you can see I used a 7.8 pip stop loss, and I was able to get at least, I don't know how much higher this went later in the day, but at least 20, 24 pips out of this quick move up within an hour. So just from using a small 7 pip stop loss, which actually put me down near the 50 EMA, which was more than plenty, I was able to make really good risk reward here, about 3 to 1. The thing about these S2 trades, and especially about these railroad formations, and I know I can say this to you and you'll listen to me and write it down and take notes on it, but you won't understand until you really have been in the market a lot, that when railroads are solid, like this one is here where it comes down, pulls up, and then continues the uptrend, which is clearly the direction that this market is going, up. If the next candle was to come down instead of go up, I would close it right there. Because I've seen enough railroads that I know if I'm taking an S2 cross on a shorter time frame, and it's a 15-minute candle formation, whether it's a railroad, a Rocky, or a shift candle, this should move. These trades should not take more than 30 minutes, 45 minutes, and most to get into profit. If it takes longer than that and you're at break even and it's been an hour, pull the trade. Take the break even, come back later. None of the S2 trades that I've traded and done historical backtesting on that we qualify as winners have taken more than 45 minutes to move into profit. The ones that take longer typically will turn out to be stalemates all day. You'll make or lose a little bit of pips, or they turn out to be losers. So if you don't move into profit quickly, pull the loss. It's just about pulling the loss quickly so that when you do get in a good trade like this, you maximize the 24 with only 6 or 7 pips at risk. And over time, all of these small wins do add up. Again, another example here. You have a really nice Rocky formation off a pivot point. You see the R1 purple pivot point. It's coming off that pivot point, off the 50 EMA in an uptrend. We know that this Rocky, see his hands are up, he's pointing up. If this next candle came down, it is not a Rocky. Get out. But you have the RSI coming through the liquid 50 in the right zone above the trend line. And what do you get? 17 pips, 18 pips of movement to the upside within 45 minutes, an hour and a half. So again, these trades are going to be quick. Really write that down, take note on that. These trades will be quick, and if you lose, you won't be losing a lot of pips. I hope that you like that. Like, I really hope that that sounds good to you. Risking 7 to make 24, risking 8 or 9 to make 18 or 19. That sounds good to me. Another example here. This is a shift candle, entry candle right here, as the RSI comes through the trend line in the liquid 50 in the buy zone. Now, it's not in the buy zone all day because it's kind of in reset, kind of drops down a little bit, but look at the EMAs. They're telling us this is an uptrend. And there's 68 pips here if you hold through till the end of the day. But you can see we have R1 right here. So we have the shift candle, the move to the pivot. It kind of consolidates at this pivot, but it's always moving higher, and then finally makes its move through 2, all the way to resistance level 2, pivot point number 2. All because the RSI crossed through the liquid 50, crossed through the trend line in the buy zone. This has an 11 pip stop loss, 10.7 at the 50 EMA. You can see the water is right here. If the next candle came down and came to the water, This would not be a solid shift candle, and the RSI would come right back down through the liquid 50. When the RSI comes down through the liquid 50 and turns against you, get out. Just wait for it to get back in. Because if it comes back up like it does later in the day here, it's going to throw another S2 entry here. So take the quick loss and then get it back here. There's potential in a trade like this to get it, take it to the pivot, pull out. Wait, get it again, take it to the next pivot. I've seen traders do that. I'm not even that good yet. I've done it sometimes, but it's difficult to do, to be that patient and to find S2 trades that fit the parameters to double tap it like that. But it does happen. It's definitely possible. Here's an example. It never hits overbought. The RSI comes down, back through the liquid 50, back through the trend line. Right here in the afternoon, you'd be looking for shorter term time frame entries. Before we move in to the TDI entry parameters and you really see how these crosses work, understand that there are four main components that go into an entry. The TDI with your crossing RSI and liquid 50, the EMAs for trend, the 3 time frames for your trend identifier and your precise entry windows, and your candlestick formations. These are going to confirm or deny what you see on the TDI. Now, let's go into the TDI entry parameters. Now we're going to go over the entry parameters on the TDI when you're looking for an S2 trade. The first thing you're going to do, I'm going to mention this again, is always remove the overbought and oversold pairs from your watch list. You're then going to read the liquid 50, that yellow line. You're going to read the RSI, read the trend line, the TDI as a whole, to tell you what direction you should be trading that pair that day. You're going to use the TDI to confirm the entry signal the same way on all 3 time frames. It's the same RSI crossing through the liquid 50 in the same zone with the trend line in the same position. You want to think of your 15-minute time frame as your window for entry, and the 5-minute and 1-minute are your precise entry tools to get in with as little pain as possible in these breakouts. Let's talk about the parameters for a long trade. You want to have the RSI value greater than the stationary 50, which would mean in the buy zone. You also want the RSI value to be greater than the liquid 50, and you want it to also be either above or coming through the trend line. The liquid 50 itself, you want to be greater than 51, but less than 69. So that would mean above reset, above 50, but less than 70 at overbought. You want the liquid 50 somewhere around 60, 58, 62. Those are right in the middle. That's where you find the nice trending liquid 50. And if you can find it in that zone all day, you're going to find a really strong trend. Something that I want to take note of here is that I never really go long in a dropping liquid 50, meaning if the value of the liquid 50 was up at 68, 65, and all of a sudden through Asia and through London, it starts to drop, going down to 60, 55, 54, closer to 50, I'm not going to most likely I'm not going to look for potential longs there. Only because that's showing me that yes, we're in the buy zone, but the trend is losing strength. So I want to trade long into rising liquid 50s or flat liquid 50s in the buy zone. Now let me give you an example of a good TDI long trade. Here you'll see we have the liquid 50 in the buy zone all day. RSI does not hit overbought. Even here, it does not hit overbought. The overbought is the black horizontal line. When you wait, this is around 6 a.m., a little bit before, you have the RSI coming through the liquid 50 and through the trend line at the same time in the buy zone before the RSI has hit overbought this day. This would tell us that we would potentially find an entry on a smaller time frame. What would the entry on the smaller time frame look like? Identical to this cross. You would also have the RSI crossing through the liquid 50 and the trend line in the buy zone. That's how you would know that it's a proper S2. Again, another example here. We have one of those dropping liquid 50s to start the day. Period separator right here. One of those dropping liquid 50s to start the day. So this RSI coming through the liquid 50 in the buy zone and this RSI coming through the liquid 50 in the buy zone are two crosses that I would not be interested in only because of this dropping liquid 50. Now, that's around midnight. This is during Asia, so this is probably around 10 p.m. Eastern time. After that point, from midnight on, the liquid 50 hits a value of about 58, it looks like, somewhere over here, 57, 58, and continues to actually rise closer to 60, telling me that the uptrend is going to continue. So when we get the RSI above the trend line, you see it's above the trend line, crossing through the liquid 50, we would then look on the smaller time frames to see if we have the proper entry. We would also want to confirm it with the candle formation. We see here a really clean 3-candle Rocky. The right leg is higher. Rocky's arms are pointing higher, telling us the trend is going to continue, and that's exactly what happens. 1, 2, 3, 4, 5 candles of rise. Another example, liquid 50 moves up from near 50, but not at 50, near 50, maybe 51, 52. Liquid 50 moves up during Asia. RSI crosses in the buy zone above trend line. You get 1, 2, 3, 4, 45 minutes to an hour of rise after that cross. You would identify it and confirm if it's an S2 on the shorter time frames, but just looking at the 15-minute chart, you can see that you get that push that you need. That's what the cross is telling you. The RSI coming through the liquid 50 is telling you that the move is going to continue in that direction. Again, here later in the day, liquid 50 stays in the buy zone, RSI never hits overbought, and you get another cross. What happens after that cross? You get about 45 minutes of a consolidation period, and then a move higher. And again, later in the day, another cross. RSI coming through the trend line, coming through the liquid 50 in the buy zone, and then another clean push higher. Now let's talk about the TDI entry parameters when you're looking to go short. It's going to be exactly the opposite of everything I just told you. The RSI value has to be less than the stationary 50, which would mean in the sell zone. You want the RSI to also be under the liquid 50 and under the trend line. You want the liquid 50 value to be less than 49, so not at reset at 50, but greater than 31, not oversold. 30 is oversold. And again, we're not going to enter short into a rising liquid 50, just like we would not go long into a falling liquid 50, even if it's in the sell zone. Don't enter short into a rising liquid 50. Even if it goes that direction and you miss out on a 100 pip move, I'm sorry. You can write me a nasty email and that's fine. But other than that, let it go. Trade trending trades. Here's an example of a really clean RSI crossing through the trend line and the liquid 50 in the sell zone. This happens a little after 9 a.m. And even before that, around 8:30, 8:45, you have another RSI crossing through the liquid 50, well under the trend line in the sell zone. The RSI has not hit oversold, and the liquid 50 has been in the sell zone since about 2 a.m., 1 a.m. Now, the EMAs aren't great here. You know, at this point, we're trying to trade, probably if we're taking this short, you're taking it to this 800 EMA. But just looking at the TDI here, we're just looking for short crosses. These are solid short crosses. To me, if you ask me, Austin, well, how long does the liquid 50 need to be in the sell zone for me to take a short trade? I would say this is plenty of time. This is towards the start of London, end of Asia. It moves into the sell zone, saying the trend for London is to sell, carries through to New York. You have 9 a.m. here. New York, we're still selling. Look at the liquid 50. And then you could even draw structure lines on this. As we get into the trades, we're going to draw more structure lines. You're going to get confirmations of structure breaking out too with these RSI crosses that are going to be almost too good to ignore. Again, here, RSI coming through the liquid 50, coming through the trend line, all within 15 minutes. And again, here, it kisses off the liquid 50. It doesn't make it all the way back to it, but it does cross down through the trend line again after 9 a.m. And you can see the first move is this railroad formation off the 50 and off the 200 EMA. It's right here with this first cross. The RSI then drops slightly, but pulls right back, just like the candles do. So you have no divergence. You have confluence in this move, meaning that this is a solid move. The RSI is reflecting exactly what the candles are telling us. So that's trustworthy. I'm going to believe that. When the RSI tries to get to the liquid 50, can't, and drops back down through the trend line, creating a 3-candle Rocky with the right leg lower in a downtrend off the 13 EMA. We know that because the right leg creates the new low of day with a body, we think that this move short should continue. And for 45 minutes, 1, 2, 3, you get straight drop. One more example here. This is a good example of a rising liquid 50 that is something we would want to avoid trading. You can see that, yes, the liquid 50 starts the day in the sell zone, so we would be looking to sell this thing. However, it starts to rise during right around the middle of the Asian session through midnight, 1, 2, 3 a.m. And by 3 a.m., it gets right to reset. The Liquid 50 and the RSI are at reset. Now, yes, it does cross down and there is a drop to the 800 EMA. But this is one of those things that I'm going to tell you. Let it go. Do not get involved in a trade like this because of the rising Liquid 50. As all of this is coming towards the stationary 50, as the RSI, the Liquid 50, and the trend line are all getting closer and closer to the stationary 50, we consider that coming into reset. And you never want to trade a pair in reset. You're going to get chopped around. We went over that already in earlier chapters. Reset is just where we want to stay away. Avoid trading it completely. Make sure you fully grasp that you need to have the RSI crossing the Liquid 50 and the trend line in the proper zone in order to have a proper S2 entry. You're going to qualify it on the 15-minute and find that precise cross on the shorter time frame in that 15-minute window to find your S2 trade. Now, let's talk about these EMAs and how we're going to use the EMAs to qualify your S2 trades even more. Make sure you have that checklist next to you and you're going down the checklist as I explain each topic to you so you understand how you're going to apply it each morning. The key points for using the EMAs at entry are very simple. If the candles are above the EMAs, we're in an uptrend and we're looking to go long. If the candles are below the EMAs, we're in a downtrend and we're only looking to go short. If the candles and the EMAs are coming together in reset, you want to be prepared for that choppy market that we're talking about. You're going to be able to confirm that choppy market using the TDI, using the positioning, the value of the Liquid 50 and the RSI. So let's get into a few examples of each direction that you could see these EMAs potentially trying to induce you to trade. Here, you can see left to right, the EMAs are clearly moving higher. EMAs moving higher left to right on the screen. This is clearly an uptrend. Trust the higher period EMAs for more reliable trend. Meaning, look at the blueberry down here, the 800 EMA. You can see candles are above that. We're above the 200. We're above the 50 for most of the day. That would tell me that we are only looking for longs. Can we confirm that with the TDI? Absolutely. The Liquid 50 is in the buy zone all day. So you could potentially be looking for long entries here all day until the RSI and TDI give you a reason not to. Whether they hit overbought or whether the Liquid 50 moves into the sell zone, moves into reset or not. But until then, this Liquid 50, and of course we're in hindsight, but you can see, stays in the buying zone all day, giving you all day of potential entries. You can see the EMAs moving higher left to right on the screen, another clean uptrend, above the 800, above the 50, above the 200, above the 8, and above the 13 for most of the day. You have an RSI cross here. However, be mindful that you did hit overbought right at the start of the day. Now, you're going to look at this chart at this point, I hope you can see, and say, Austin, yes, it hit overbought, but look at this huge move up. And you're telling me we cannot be trading that because it hit overbought early in the day? And I'm going to say absolutely not, because you need to stick to these parameters very strictly. If you agree to trade the S2, you cannot go long if it hits overbought. And it clearly hit overbought right here. So you could not take advantage of this move. It's just not your pips. And accept that. It's going to be hard, but just accept it. I promise it leads to more consistent winning over a longer period of time. Let these trades go. Stick to a very, very, very tight set of parameters that I'm giving to you in this course, and you're going to be able to apply that every day to long-term consistent winning. Let me show you a short example with the EMAs. You can see the candles move below the 800 EMA during the start of the London session, hold below the 800 EMA through London session, and then into New York, continue downward away from the 800 EMA. The short-term EMAs begin to cross through as the day goes on, telling us that this is now a downtrend. How can we confirm that? We look at the TDI and see here that the Liquid 50 moved into the sell zone during Asia and continued down and held at a great value, right at the 40 value all day long, giving us an opportunity right here before 9 a.m. The RSI had not hit oversold. We have an RSI crossing through the Liquid 50 and the trend line right here. We would look to confirm that with the candles, and if you're really good, you could even see that this is a Rocky formation right here with 4 candles. The right leg closes for a new low, breaking out of this consolidation range here, and you get 1, 2, 3, 4, 5, 6 candles of straight drop. All from the RSI cross, confirmed with the EMAs, and confirmed with a candle formation. You would absolutely find either a 5-minute or a 1-minute S2 cross within this 15-minute candle, 100%. Here, another example, you're under all the EMAs, everything is telling you to sell. However, the liquid 50 was in reset all the way until 9 a.m. Not until 9 a.m. did it start to drop away from that stationary 50 value, telling us the downtrend was ready to continue. On a day like this, if you were trading in New York, you probably would not get a trade if you were trading strict S2s. I don't see a clean S2 in this. So what does this tell us? Trust the liquid 50, even if the EMAs are like, yes, you want to sell, yes, you want to sell. If you don't get a clean S2 entry on this TDI, it's not worth your time. I promise. Let me explain to you how you can identify reset using these EMAs. Here we have what looks like from the day before a downtrend. However, during Asia, the low is set. We move away from that low, and through the beginning of London, it continues up higher. The liquid 50 started the day in the sell zone, but crossed into the buy zone. The RSI hit overbought, and this whole chart starts to get really messy right around 4, 5, 6 a.m. You have the EMAs coming together, which we know are all resistance levels, and when they come together, we know that's reset. The RSI hits overbought. So basically, you should look at this chart here and understand that this is something you just want to take off your watch list. You really don't need to analyze it any further than that. Don't overcomplicate this. Read it and say, well, Austin's telling me we need the liquid 50 and the TDI in the same zone for the majority of the day. Here, it moves into the buy zone, so we would then be looking to go long. However, it hits overbought right away, so we couldn't take it long anyway. So take it off the list. Here, reset again. The short-term EMAs, the 50 and the 200, are coming towards the bringing the candles towards the 800 EMA, crossing right before 6 a.m. down towards that 800 EMA. How do we know it's going to go to the 800 EMA? How do we know we're in a short-term downtrend? Look at the TDI. Liquid 50 from start of day has been in the sell zone the entire time. It made an attempt to get towards the stationary 50, but could not do it and continued back down lower underneath the 40 value. It never hits oversold, but it holds really nicely to show us that, yes, these EMAs are coming together, but we know that by... So this is a really good example of something we would just try to avoid trading, unless you like to counter trend trade, which is something that advanced traders will always gravitate towards once they grasp these concepts. But at the onset, I want you to just focus on reading this and saying the EMAs do not agree with the TDI, so we are going to avoid trading this. There's a few key points I want to touch on with the EMAs. You never want to enter off the 8 EMA, off the mustard. The reason I actually left that on the charts is to show you an exit signal that we're going to get into later on when we talk about take profits. If the candles come back and close within the 8 EMA, we want to consider pulling the trade out. The higher valued EMA that you enter off of, meaning if you get a formation off the 50 or the 200 EMA as well as the 13 EMA, you're going to get a much more powerful trade. If you are trading against the overall direction of the EMAs, like I said, if you're trading counter trend, you want to use them as support and resistance levels. Don't expect it to just blow through each of your lines. It will not do that. It will absolutely find support at the EMAs. Now, what I mean when I say off the 8 EMA is that if the body of the candle that you're looking to enter on, meaning if we're looking at a 15-minute chart here, and if the 15-minute candle body opens on the 8 EMA, like this candle that I have boxed in does, or opens off the 8 EMA, like the candle after it does. You see how this candle opens way down here, not touching any of the EMAs very clearly? These are two good examples of candles where even if we saw an entry on the shorter time frames, we would not get involved here. The reason that we keep the 8 EMA on our charts is to keep us out of potential bad trades. If you're in a trade off the 13 EMA, off the 50, or off the 200, or even the 800, you're going to use the 8 EMA as a barrier, almost as if the candles close back within the 8 EMA, like they do for the first time right here. You see how this candle pushes off the 8 EMA and none of these candles close back with inside. This one leaves a wick, but it does not close underneath the 8 EMA until right here. When it does close under the 8 EMA, we're going to use that as a signal that the trend might be over and it might move into some consolidation. So the reason that we won't enter off the 8 EMA or enter on candles that are not touching any EMAs is because we aren't sure how much more of that move we have left. We know if we enter off a solid EMA, I call them sometimes hard EMAs, either being the 13, the 50, or the 200. If we enter off of one of those EMAs, we know we're going to get a more substantial move. But if you enter off the 8 or off no EMAs, there's a chance that your move is actually over and you're entering too late. Another example here, you can clearly see the candle in this box is not touching any EMAs at all. Even if the pin was touching it, we want to see solid bodies off the EMAs. This is a good example to show you that even if you entered here, you would have made money. However, to stick to the S2 pattern, to stick to the parameters that we trade, once this candle pushed off the EMAs, if you are not in it, you have to wait for it to come back or you cannot trade it. And when I say come back, I mean pull back to the EMAs and give you another signal to trade this long. So here, we would look at this and say, yeah, there might be entries on the shorter time frames, on the 5-minute or the 1-minute in this 15-minute candle. But we're not going to trade those entries because it's off the 8 EMA. Now let's use candle formations to tie the whole thing together and explain how we're identifying proper S2 entries. The next few examples I'm going to show you are going to include all 3 time frames. We're now going to see the 15-minute chart, the 5-minute chart, and the 1-minute chart. The reason for this is because I want to tie this concept to the earlier chapter where I explained to you that with railroads and Rockies, you're going to find 5-minute crosses more than you're going to find 1-minute S2 crosses. And to that point, you're going to have shift candle entries that have more 1-minute crosses than they do 5-minute entries. So before we move forward and I show you these 3 time frames, understand this. The reason I'm showing you all 3 from now until we finish this course is because I want you to pay attention to where the S2 cross on the shorter time frame is in correlation to the candle formation that you're going to see on the 15-minute chart. Railroads and Rockies, you're going to find more 5-minute S2 entries than 1-minute S2 entries. Shift candles, you're going to find more 1-minute entries than you're going to find 5-minute entries. Shift candles, a lot of times, will have 3 for 3, meaning they'll be crossing on the 15-minute, the 5-minute, and the 1-minute. So there'll be lots of entry signals. Now let's get into the examples. The first example here, we're going to always start on the left side of the screen looking at the 15-minute chart. We can see we're looking at GBP AUD on the 15-minute time frame, and here we see a clean railroad formation off a solid EMA, off that 13 EMA. The right leg closes above the consolidation zone, making a new high. And if we look up here on the 5-minute, we have an RSI crossing the trend line and the liquid 50 in the buy zone above the 50 value, giving us the 5-minute entry. And from that entry, we get straight rise all day for about 51 pips. Look at how, after your entry, it stays above the 8 EMA all the way up here. That's about 35 pips just from your entry. So just reading this chart and using the EMAs as support and resistance and using the candle formations to give you the entry signals, you can see you get the entry window open on the 15-minute. You get the sniper entry on the 5-minute. There is no 1-minute cross until later on, which confirms that the trade is going in the direction you want it to go as the liquid 50 moved up and the RSI continued to cross it through the Asian session here. That's confirmation on the 1-minute. But the 5-minute was your exact entry. You use the EMAs to keep you in or get you out of the trade, and you can see here that it rides outside that 8 EMA for a couple hours very, very, very nicely. Another example here, this time I'm going to add in some structure. You can see we have confirmation of structure with the trend lines on the RSI, matching the reaction points on the candles, here and here, here and here. We're also moving off yesterday's high, which was set right here. The railroad formation here coming through the structure off yesterday's high, and the 15-minute railroad formation right here that I have boxed off in pink is closing for a new high of day. From that move, you get 12.7 pips straight up to the pivot point. You see the R1 pivot point right there. There's a 5-minute cross right here at about 1:20 in the morning. The 1-minute is very close to throwing an entry, but does not cross in the proper zone. You can see that cross is actually in the sell zone. There is a cross right before 1 a.m., but the proper entry that we would be looking to take is the 5-minute cross as the right leg of the railroad closes for a new high of day. I'll repeat that one more time. When you're trading a railroad or a Rocky, your precise entry is on the 5-minute RSI cross in the proper zone with the liquid 50 and the trend line in the proper position. Another example, this railroad here, 2 candles again, right leg closes for a new high of day, clearly in an uptrend, liquid 50 in the buy zone all day. And I hope you're starting to see that the first thing I look at every day is the 15-minute. We're always looking at the 15-minute. The short-term time frames, they only come once the 15-minute window is open. If this isn't right, these won't be right. So don't worry about this until we qualify the 15-minute. When the right leg closes for a new high, you're on the shorter time frames looking for an entry. And here in this railroad, this is why I left this in the course, you get a 1-minute cross at 4:36 and a 5-minute cross 4 minutes later. So first the 1-minute cross, 4 minutes later, the 5-minute cross closes as the RSI closes through the liquid 50, closes through the trend line in the buy zone. That's 3 for 3 confirmation because on the 15-minute, the RSI is above the trend line, above the liquid 50, and in the buy zone, telling us that we're trying to go long. And what we would then be looking at is the key levels of structure to see how far we could take this trade. You are close to the pivot when this trade presented, so that might keep you out of it. But if you did get in, you can see we get 1, 2, 3 candles of rise right to yesterday's high, which is the blue line going across the screen. You get 45 minutes of rise, a little bit of consolidation, about an hour and a half, 2 hours of consolidation, but then another move off yesterday's high to make new highs for about 26.5, 27 pips. So here you see the 3 for 3 crosses, the railroad making the new high of day. The entry is when the RSI comes through the liquid 50 with the trend line in the right position, with the TDI in the right zone on the shorter time frames. Another example here. This is a railroad that looks very similar to example number 1, but this is different. And why is that? Well, if you look at the 5-minute, you'll see that we do not get an RSI crossing through the liquid 50 and the trend line in the proper zone, but it does move up. That's because your entry is actually on the 1-minute chart. You can see there's 2 times within 10 minutes where the RSI crosses through the liquid 50, we're in the buy zone, through the liquid 50 and through the trend line to continue to move higher. This railroad formation, the right leg is higher than the left leg and it closes for a new high of day. You get 26 pips of rise outside the 8 EMA. Are you starting to see the pattern? Let me show you some Rocky trades. Again, here you have the 3-candle Rocky formation with the right leg closing lower than the consolidation zone that started right here at the beginning of Asia. From when this Rocky closes, when this Rocky is starting to form, you're on the smaller time frames looking for a shorter term time frame entry to close. You get the RSI to come through the liquid 50 and the trend line in the sell zone on both the 1-minute and the 5-minute at 2023 and 2020. That's GMT time. So as this is during the Asian session, as this crosses on both time frames, as it's throwing the Rocky on the 15-minute formation, if you look inside there, the Rocky is actually off not only the 13 EMA and the 50 EMA, but it's pretty close to the 800 as well. From the previous day, we were under the 800 EMA, telling us that we were going to continue to sell, and the liquid 50 was in the sell zone. Now, it did move towards reset, which might keep some of us out of this trade, but it still was definitely in the sell zone. Everything is always binary. It's going to be yes or no. It's not, oh, it's kind of in the buy zone. No, it's either in the buy zone or it's not in the buy zone. That's simple. Here's another Rocky. These are formations that we love to see. When you find that doji right in the middle of it, right on a solid EMA, like the 50 EMA here, you know that if this throws a doji and the next arm comes up, meaning Rocky puts his right arm up and his right arm closes higher than his left arm, then we're going to potentially, if it's confirmed on the TDI, like this one is, with the RSI coming through the liquid 50 and the trend line, we're going to then see the move up. And this is 29, 30 pips straight up after this Rocky. Look at the 1-minute. There is no entry. But when you check the 5-minute, all day, 5-minute liquid 50 in the buy zone, RSI comes through, trend line is underneath it, never hit overbought during this day, everything looked good to go, and that's why you get 30 pips of clean rise. That's really it. It's the same cross on the 15-minute as it is on the 5-minute and the 1-minute. You open the window with the 15-minute and then jump through, shoot through, dive through, whatever, run through with the 5-minute and the 1-minute entries. Here we're going to add in some structure. Again, you can see the uptrend with my blue trend line confirmed on the RSI and the candles. You can see the pink top line of the structure is broken as the RSI comes through the trend line above the liquid 50 and the right leg of the Rocky closes higher than the consolidation range. The next candle after that Rocky breaks initial high of day, which confirms to us that this is now a solid breakout and we should see movement to at least the next pivot point. The pivot point is right here. It's a little faint. I know I made them white for this markup. I'm not sure why. But you can see from the entry on the 1 minute here at 5:18, there is no 5 minute, there is only a 1 minute. As this 1 minute entry throws, the Rocky closes his right arm higher. The 1 minute entry is in that large candle, that 1 minute, that 15-minute candle that closes higher. We then move straight up outside the 8 EMA to the pivot point, and when we get to the pivot point, it puts a body right through it. Moving a little higher before pulling back to the pivot, retesting it, confirming it almost as a level, and then moving much higher off of it, over 100 pips by the end of the day from your original entry. So no 5-minute entry for the S2, but definitely a solid 1 minute entry. And there's multiple 1 minute entries. You can see the RSI comes through multiple times without hitting overbought on the 1 minute chart. In this example, you can see we have the liquid 50 coming into the sell zone right at the end of London, right at the beginning of New York. You have the confirmation of structure that you see with my pink lines and a clean Rocky formation right off the structure line, right off the 13 EMA with a 5-minute entry. Look at the liquid 50 and the 5-minute. Clearly in the sell zone. RSI comes through under the trend line, not oversold. No 1 minute cross, but after about an hour and a half of consolidation, it drops straight to the floor for about 28 pips. So again, I don't want to beat the dead horse, but you should very clearly be able to identify if this S2 is valid by looking at the candle formations, looking at the market structure, looking at the key levels, and then finding the entry on the shorter term time frames. Another clean looking Rocky here with that right leg creating a nice new low of day far away from the consolidation during Asia. Liquid 50 in the sell zone, holding this trend line that I drew from earlier in Asia with a 5-minute and 1 minute entries. So you have a 130 and a both of them are right at 130. Look at that. You can see the times. Right at 130, the 5-minute closes and crosses through, the 1 minute closes and crosses through, and then within 25 minutes, you're already up 8 to 10 pips. And if you hold all day, there's over 35, 40 pips in this trade for you between both pivots. So you're able to see again how it moves outside the 8 EMA, outside the 8 EMA, does not close back within the 8 EMA until way later on here around 6 a.m. So from 1:30, 2 o'clock a.m. until 6 a.m., it was pretty much straight drop. A little consolidation at the end here, but other than that, it was straight drop. Now let's go over shift candle entries. Shift candles are going to be the same thing, except you're going to not see a clean candle formation. Instead, you're going to see what we'll sometimes refer to as like an ignition bar, but a more of a shift of the zone where you see the 8 and 13 EMA crossing on that candle. It will be confirmed, like I told you in earlier chapters, with the RSI coming through the liquid 50 and the trend line in the proper zone. Here you have a 5-minute entry, RSI coming through in the buy zone with the liquid 50 and trend line in the proper position. During, you see I have the pink lines marked up, during the shift candle. So when you get the entry on the 5-minute or the 1 minute during the 15-minute shift candle, that's the solid trade. Even though there is no 1 minute, you can still trade 5-minute crosses. If you can get all 3 crosses and you only traded all 3 crosses, you would very rarely lose. However, you can still profit with trading on either just the 15-minute and 5-minute confirmations or just the 15-minute and 1 minute confirmations. Another example here, the EMAs come tight together right before New York. This is about 5, 6, 7 a.m. We get the shift candle as the RSI comes through the liquid 50, comes through the trend line. 5-minute cross at 7:30, a 1 minute cross a little bit later, closer till 8:15, and then you get the 12 pips of rise. As the EMAs come close together in this example, I want you to see that the way we identify where the proper shift is, not the floating shift, but the solid shift, is by using the TDI and identifying when the RSI is coming through the liquid 50 and the trend line. We always want to refer back to this TDI. Don't trust the candles. If it's look at everything that I've told you up until this point has been to trade off the TDI and use the candles to confirm what you're seeing, not to give you any information, give you any new information. When the TDI is crossing, that's the S2. When the RSI is coming through the liquid 50 in the proper zone and the other parameters are met, that's the S2. It has nothing to do with the candles. The candles just confirm it. So don't be fooled. Clean shift. Look at the RSI. Look at how high that trend line is above it. Clearly in the sell zone, never sold. RSI shifts through the liquid 50. Candle drops down off the 50 EMA, forcing the 8 and 13 EMAs to cross. You get 100, almost 200 pips of drop in this pair. This was a huge trade on EuroCAD. You can see, however, there's no 5-minute entry, but there is at 436, 437, a really nice 1-minute entry. And within 23 minutes, you're up about 19, 20 pips. I will never understand how someone could hold all day and catch all of this. I hope that one day I can, because you can even see here that, yes, it does stay outside the 8 EMA, but only until right here where it then decides to consolidate, which is also a pivot point. You will not see moves like this too often. So when I saw the consolidation here at pivot point number 2, you can see it's labeled right here. When I saw this consolidation, you can't go broke taking profits. Just take it. Take the 10, take the 20, take the 30, whatever you can get. Just focus on netting profits over the long period of time. We've now gone through the TDI, the EMAs, the candle formations, and the time of day. I showed you specifically how to find the S2 entries using the TDI, how to confirm those S2 entries with candle formations and EMAs, and how to make sure that you're catching those S2 trades by waiting for the cross to actually close. And that will keep you from entering early and getting into pain. So if you have any questions on this chapter, please rewind, please look over your notes, send me any questions you have. We're now going to move into S2 exit signals.